Hello, everyone, and welcome to Ancient Roman Trading Secrets with General Romulus. That's me, Romulus. This show is brought to you by Backpack Trader. Our goal is to help you become the best version of the backpack trader you possibly can become. And what does that mean, backpack trading? It means doing a little bit of trading, put a little bit of time into helping to grow your portfolio, but not a ton of time. I used to work 90 hours a week. I started on Wall Street in September 1994. I worked 90 hours a week. You believe that? Not even close to that type of time these days. And that's what we want. It's the summertime. You should be by the pool, at the beach, in the mountains, riding your bike, going on a hike, doing anything other than spending 90 hours a week in front of a computer screen trying to squeeze out one more little percentage gain. It's not worth it, everybody. You'll burn out. So backpack trading, that's what we do. That's what we want to help you do as well. So let me bring something up here. Yesterday and the day before, we were talking about GameStop. Earnings came out, and it really happened in exactly the way we discussed it on the videos. Look at the last two videos, and we said that they were going to beat on the top line, which is the revenue number, and they did, again, by almost 5%. They were going to miss on the bottom line, on the net number, and they did by 43%, but the stock was still going to go higher. Look at that. That's exactly what happened, everybody. They beat on the top line, they missed on the bottom line, and the stock went higher. That's a trading secret, an ancient Roman trading secret brought to you by your old buddy, Romulus. That's me. How did I know that was exactly what was going to happen? And again, just watch the last two videos. You'll see right there for yourself. It's exactly what I said, and I didn't say anything else. I didn't have, a typical economist on one hand and on the other. I said exactly what was going to happen, and that's exactly what did happen. How did I know? Okay, well, let's break that down. That's the useful piece of information. First of all, I looked at the last couple of revenue situations over at Gamestop. Okay, let me click over here. So here you see they beat on the top line. They missed. They flattened out here. They missed on the bottom line, okay, by 168%. Same thing on the next earnings. Look at that right there. They beat on the top line. They missed on the net, on the income number. Okay, so there's a pattern going on here, and life is about patterns. The pattern is that the company beats the revenue number and misses on the earnings number, okay? Now, how about the stock going up? Well, you see how it's already been down aggressively in here. That was pricing in a lot of bad news already, okay? Plus, in the last couple of trading days prior to the earnings, it had gone down a fair amount. I mean, look, the stock was trading at $148 just a few days ago, and then went down yesterday to $117. So a pretty good clip just in a few short trading days. On those selling periods, though, you see the volume dropping. See that right there? But on the blast off, the volume was up quite a bit. That's another piece. And the last one is there's a very slight, very, very slight little upward bullish bias in the general stock market over the extremely short term. This is not something I'd be trading on. I'm not going long, nothing like that, because the intermediate and longer term trends of the general stock market are still down, and that is the easier way to trade in general. In addition, a company called Salesforce.com had earnings a couple of days ago, the other night, and then when it opened for trading the next day, there was a 10% shot to the upside on the stock. Okay, and a pretty good volume coming along for the ride. So this would have been the opposite if that was taking place in maybe the middle of April, early May. The stock would have been bombed to the downside. But instead, like I said, there's just a little bit of a very, very slight upward tilting bias, bullish bias of the market right now. So when I combine all those factors into play, I came up with a scenario that, well, turned out to be dead on nuts accurate for our old buddy GameStop. I didn't buy the stock because, again, the bigger picture of the market, the intermediate longer term trend of the market is they're both down. There's still downtrends going on. We can see that right here. Come take a look with me. I'll show you this quite clearly. This is the S&P 500. This is the main index you want to watch all the time. And when I'm doing this type of work, I'm moving it to a line chart, just easier to see. So starting off back here, January 4th, that's the all-time high of the stock market right there at 4816 or 4818, right around in there. And then you could see that it's putting in a series of lower highs and lower lows. That's a definition of a downtrend just because it has eclipsed the 21-day exponential moving average does not mean that the intermediate longer-term downtrends are done. They are not done. Okay, as a matter of fact, I feel there's a high probability that sometime between now and the end of September, so a little less than 4 months, the lows of May 20th will be taken out to the downside. How aggressively? Well, doesn't have to be much. Doesn't have to be much. Even if it does it by just 1%, a whole lot of people who are begging, pleading, and just praying hard that that was a new bull market low, they'll have their heads handed to them once again. And I'm hoping and praying fervently that that isn't you. We don't want that for you. We want you to be a backpack trader, not a top tick Harry. Okay, top tick Harry is no way to go about your business. Okay, so as we move on here, though, we've now done with the GameStop situation. The next big event in the stock market is going to be interest rates, Federal Reserve, interest rate meeting, Federal Reserve meeting coming out June, I believe it's 15th, 16th, somewhere right around in there. So a little less than 2 weeks away. We all know they're going to raise interest rates again. Everybody knows that. They're going to raise rates 50 basis points, although they should do 75, but they don't have that kind of spine. But they're going to raise interest rates by 50 basis points. Everybody knows that. The question is, what do they say after? That's always the conversational piece. And they're going to say what they've been saying. They're going to keep raising interest rates until they see inflation turn down. And look at the price of oil at $117 a barrel today, reaching almost 120 just a few trading days ago. And that is telling you quite clearly and easily, you can see it for yourself, inflation is not gone. Okay, until oil goes back down significantly, not like this, but significantly lower than where it is now, you're not going to see inflation cool off. So the Fed, they've got a problem on their hands. Yes, they do. They've got a real problem on their hands. They're not going to, they don't seem to be willing to do what it takes, which is a 100 basis point jack next in 2 weeks. Really get it done. I mean, really get this thing taken care of, rip the Band-Aid off, pull the market down for a couple of weeks, and then let's get this thing back going again to the upside. But they're not into that, okay? They're pansies, they're weak, they pander, they're politically motivated, and they don't have what it takes to get it done. But that's typical of government officials. Okay, as we go here, though, expect to see a lot of conversation and moves around the markets based on the Fed meeting. Again, 50 basis points coming up in a couple of weeks. Oil prices remaining high. That's the problem for the Federal Reserve. Inflation stays hot until that changes. All right, as we were saying here, bear market's still very much alive. Downtrend still very much intact. Nothing has changed really internally or externally to prove that otherwise. So it's still time to be incredibly careful, incredibly cautious. And, the days for being a hero, they're not right now. I know a lot of people out there, like millions of people, and it doesn't matter, institutions or retail alike, they're all just, again, begging for this May 20th low to be the new bull market and the start of something, upside. And a few weeks, probably a few months, they'll be disappointed once again. Just like they thought late November was the bottom, they thought this 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 was the bottom, this was the bottom, they thought this was the bottom, they thought this was, and it just keeps going. Okay. I traded through 2001 and 2. I traded through 2008. Same kind of thing. Every few weeks or sometimes every few months, there'd be some kind of a low like this, and the market would close higher on the day after a big down day. They'd say, see, selling climax, it's over. And then everyone would pile back in, go up for a few weeks, maybe a few months. And then a few months later, markets are lower and they're all just crying again. Okay. It happens again and again and again until you get that selling climax, the real capitulation, which there are ways to determine for real if it comes in, not like these other ways that are not working for people. There's ways to tell if it works for real. We can teach you that, of course. But anyway, I'm going back to ancient Rome, everybody, to do my own version of backpack trading, which is watching chariot races, gladiator games, and going to giant parties. That's what we do in ancient Rome. And I've been pretty thrilled and excited to bring you what has been a very, very fun-filled week. Be back again next week. So that's all for now. I'm heading back. I will see you guys soon. Take care.